The COMEX registered silver supply has dropped 33% since September. Only 27 million ounces remain available for delivery today. At the same time, open interest represents more than 600 million ounces. Those two numbers cannot coexist forever. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now registered inventories are falling while paper demand remains elevated. That shift deserves attention. Let's get straight into it. The data begins with COMEX warehouse reports published by CME Group. Registered silver stood near 40 million ounces in September. Latest CME warehouse data shows 27 million ounces registered today. That is a decline of roughly 13 million ounces. The drop represents 33% in roughly 6 months. Open interest on COMEX silver futures currently exceeds 120,000 contracts. Each contract equals 5,000 ounces. That represents over 600 million ounces of paper claims. Compare those numbers carefully. 27 million ounces registered supply. Over 600 million ounces in paper exposure. The ratio approaches 22-1. Think about what that sequence actually means. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Let's story today. CME Group COMEX Silver Warehouse System. Registered inventory sits near 27 million ounces. Eligible inventory remains roughly 260 million ounces according to CME reports. Only registered metal is deliverable against futures contracts. Eligible metal requires conversion before delivery. Effective this week, the registered pool continues shrinking. This follows a steady drawdown since late summer. Warehouse withdrawals accelerate during several recent sessions. The unusual detail is the speed. 13 million ounces disappear within months. Open interest does not fall during the same window. The timing is what deserves scrutiny, not the decline itself. The timing. Think about what that sequence actually means. When supply contracts while paper exposure holds steady, tension builds inside the market structure. That tension does not resolve quietly. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last major COMEX registered decline occurred during 2020. Silver prices tripled within roughly 12 months afterward. The data is already telling you something. Let's build it out. Now let's build the full picture because the COMEX inventory decline does not exist in a vacuum. CME Group warehouse reports update daily. COMEX data shows registered silver falling 13 million ounces since September. That is the fastest percentage drawdown since 2020. The United States Geological Survey reports global annual silver mine supply near 820 million ounces. The Silver Institute estimates total annual demand near 1 billion ounces. That implies a structural deficit near 180 million ounces. Think about that scale. The deficit exceeds 6 times the current registered COMEX supply. London Bullion Market Association vault data reports roughly 800 million ounces stored in London. Industrial demand continues rising simultaneously. Solar panel manufacturing consumed roughly 160 million ounces last year, according to the Silver Institute. Electric vehicle growth also increases silver consumption in electronics. The rate of industrial demand is not slowing. It is compounding. The data is doing the talking. The ones who are called alarmists for mentioning structural deficits are quieter critics today. And here is what makes that picture even harder to ignore. The paper leverage ratio on COMEX now exceeds 20-1. That means 20 ounces in paper claims for every registered ounce. At the same time, daily trading volume often exceeds 500 million ounces equivalent. That is nearly 20 times the physical registered pool trading daily. That is not a contradiction. That is the setup. And before anyone takes that as a green light, the timeline remains uncertain. Setups can take years to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the macro variable enters the conversation because this is no longer background noise. It is the primary variable. Global central banks purchased more than 1,000 metric tons of gold during 2023, according to the World Gold Council. China continues expanding strategic commodity stockpiles. The People's Bank of China reports steady gold reserve additions across multiple months. Commodity security has become national policy across major economies. Industrial policy in the United States also expands domestic manufacturing demand for metals. The Inflation Reduction Act allocates billions towards solar infrastructure. Solar technology requires significant silver input. Every gigawatt of solar capacity requires roughly 20 metric tons of silver. Multiply that across global renewable build-out plans. The math becomes unavoidable. Markets are still pricing stable supply assumptions. Look at the structural deficit and tell me what probability you assign to stability. When markets begin pricing tighter physical availability, the response historically appears first in premiums. Shanghai Gold Exchange silver contracts occasionally trade above Western spot prices during supply stress. When that happens, physical flows shift eastward. That pattern has repeated several times across the past decade. It has not been different yet. Silver Western spot currently trades near $24 per ounce. Shanghai silver contracts occasionally trade modest premiums during physical demand spikes. The short-term picture remains mixed. Futures positioning shifts daily. If registered inventories continue declining while open interest remains elevated, physical tightness increases. If open interest contracts alongside inventory declines, pressure eases. That is the only short-term read that matters right now. As for trading it, the picture remains unclear on shorter time frames. Nobody knows tomorrow's move with certainty. Market liquidity shifts quickly during commodity cycles. Sidelines is not weakness in this environment. It is the only edge right now. The tape decides. Not me. Here is the honest truth. Both sides of this trade have a real case. The one ignored becomes the expensive one. The bear case is real. Global economic slowdown could reduce industrial silver demand. Higher interest rates strengthen the dollar and pressure commodities. Large eligible inventories could convert into registered supply if needed. The bull case is equally real. Structural supply deficits persist according to the Silver Institute. Renewable energy expansion increases long-term silver consumption. Falling COMEX registered inventory tightens deliverable supply. Size correctly. Know what you are in before you enter it. The physical market already knows where this is going. The paper market continues debating probabilities. That argument does not last forever. Everything shown today points towards structural pressure building beneath the surface. The only real question involves timing rather than direction. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group COMEX Warehouse Reports. The Silver Institute Annual Market Report. United States Geological Survey Commodity Statistics. Logic over hype. Always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for mainstream confirmation. They verify the numbers early. OG John AG 1.0. Out.